Welcome back to our channel, where we empower beginners to make smart investment decisions. Today, we'll be discussing the top 9 mistakes that new investors often make and, more importantly, how to avoid them. So, if you're just starting your investing journey, this video is a must-watch. Let's dive right in. Number 1. Succumbing to information overload. Succumbing to information overload is a common mistake that beginner investors should be aware of. In today's digital age, there is an abundance of information available about investing, which can be overwhelming. With countless news articles, blogs, forums, and social media platforms providing investment advice, it's easy to get caught up in a never-ending stream of information. However, consuming too much information without a filter can lead to analysis paralysis, where you become overwhelmed and unable to make decisions. It's crucial to strike a balance between gathering information and taking action. Focus on reputable sources, diversify your research, and develop a systematic approach to analyzing and interpreting the information. Remember that quality is more important than quantity when it comes to investment information. Number 2. Overconfidence. Overconfidence is a common mistake that beginner investors should be cautious of. When investors experience early success or witness a string of positive returns, they may become overly confident in their abilities. This inflated sense of confidence can lead to excessive risk-taking and poor decision-making. Overconfident investors may overlook important factors, neglect proper risk assessment, or ignore market signals. They may engage in speculative investments without conducting thorough research or diversifying their portfolio. Unfortunately, overconfidence often leads to losses when the market environment changes or unexpected events occur. It's important to maintain a healthy level of self-awareness and humility when investing. Recognize that markets are unpredictable, and no one has a foolproof crystal ball. Continuously evaluate your investment decisions, seek advice when needed, and remain grounded in a realistic understanding of your abilities and limitations. Number 3. Failing to educate oneself. Failing to educate oneself about investing is a common mistake that can have significant consequences. Without a solid understanding of investment principles, strategies, and various financial instruments, beginners may make uninformed decisions that lead to poor outcomes. Moreover, they may miss out on valuable opportunities for growth and wealth accumulation. It's essential to invest time and effort in learning about different asset classes, risk management techniques, market analysis, and investment vehicles. This knowledge equips investors with the necessary tools to make informed decisions and adapt to changing market conditions. By continuously educating oneself about investing, beginners can increase their chances of making sound investment choices and achieving their financial goals. Remember, investing is a lifelong learning process that rewards those who are willing to invest in their own knowledge. Number 4. Neglecting to do proper research. Doing proper research is the backbone of successful investing. Without a solid understanding of the investments you're considering, you're essentially gambling with your hard-earned money. Thorough research helps you assess the financial health and stability of a company, allowing you to make informed decisions. It's crucial to analyze factors like revenue, profitability, debt levels, and competitive advantages. Additionally, staying updated on market trends and industry developments gives you an edge in identifying potential opportunities or risks. Remember, investing is a continuous learning process. Take advantage of the vast resources available to you, from financial books and educational videos to reputable financial news sources. The more knowledge you acquire, the better equipped you'll be to navigate the complex world of investing. Number 5. Following the crowd. Following the crowd can be a dangerous pitfall for beginner investors. It's natural to seek validation from others or feel compelled to jump on the bandwagon of popular investment trends. However, blindly following the crowd can lead to poor decision-making and significant financial losses. Remember that the crowd may not always have the best information or a long-term perspective. Instead, Focus on conducting your own research and analysis. Develop a disciplined investment strategy based on your goals, risk tolerance, and understanding of the market. While it's valuable to seek advice from experienced investors or financial advisors, always critically evaluate their recommendations and make decisions that align with your own judgment. Investing is about making informed choices, not following the herd. Trust in your abilities and stay true to your own investment principles. Number 6. Not setting clear investment goals. Not setting clear investment goals is a mistake that can hinder the effectiveness of your investment strategy. Without well-defined goals, you may lack direction and find it challenging to determine the appropriate investment approach. Clear goals help you establish a timeline, risk tolerance, and desired returns. They provide a framework for making investment decisions and evaluating your progress. By setting specific goals, such as saving for retirement, buying a house, or funding a child's education, you can align your investment strategy accordingly. Clear goals also help you stay disciplined during market fluctuations, as you can focus on your long-term objectives rather than short-term volatility. Take the time to define your investment goals and regularly review and adjust them as needed to stay on track towards financial success. Number 7. Not diversifying your portfolio. Not diversifying your portfolio can expose you to unnecessary risks and potential losses. Putting all your investments in a single asset class or a few select stocks is like placing all your bets on one outcome. If that investment performs poorly, your entire portfolio will suffer. Diversification is the practice of spreading your investments across different types of assets, sectors, and geographic regions. This approach helps reduce the impact of any single investment's performance on your overall portfolio. For example, if one sector or region experiences a downturn, other investments may offset the losses. It's important to remember that diversification does not guarantee profits or protect against all losses, but it can help manage risk and increase the likelihood of long-term success. So, don't put all your eggs in one basket. Instead, aim for a well-diversified portfolio that aligns with your risk tolerance and investment goals. Number 8. Letting emotions drive your decisions. Emotions often cloud judgment and lead to poor investment decisions. Letting fear or greed dictate your actions can disrupt your long-term investment strategy. During market downturns, it's common for beginner investors to panic and sell their investments at a loss, fearing further declines. However, this reactionary behavior can lock in losses and prevent you from benefiting when the market eventually rebounds. On the other hand, getting caught up in speculative trends driven by excitement and greed can lead to impulsive and uninformed investment choices. To overcome these emotional traps, it's crucial to stay calm and think rationally. Stick to your well-thought-out investment plan, which should be based on your financial goals, risk tolerance, and time horizon. Remember, successful investing requires discipline and a long-term perspective. Don't let short-term emotions derail your financial future. Number 9. Giving up too soon. Giving up too soon is a mistake that many beginner investors make. Investing is a long-term endeavor that requires patience and perseverance. It's natural to encounter temporary setbacks, market downturns, and fluctuations along the way. However, it's important not to let these challenges discourage you from your long-term goals. Successful investors understand that market cycles are inevitable, and they stay committed to their investment strategy. They recognize that short-term volatility is often overshadowed by long-term growth potential. By maintaining a long-term perspective and staying the course, investors give their investments time to compound and grow. Remember, successful investing is a marathon, not a sprint. Stay focused, remain disciplined, and resist the urge to make impulsive decisions based on short-term market movements. And there you have it, the top 9 mistakes to avoid when you're a beginner investor. Remember, investing is a journey, and it's normal to make mistakes along the way. The key is to learn from them and keep improving. If you found this video helpful, give it a thumbs up and subscribe to our channel for more investing tips and strategies. As always, thanks for watching, and happy investing.